Today we are going to discuss about the non-banking financial companies, which is commonly known as NBFCs. The functions, types, and the activities of non-banking financial companies are discussed in this section. Non-banking financial companies are companies that are incorporated under the Companies Act of 1956 and conduct their financial business as their principal business. That is, they are registered or incorporated under the Companies Act and their principal business is the financial business. The companies whose principal business is other than financial business, like companies with principal business of agriculture operation, industrial activities, trading, services, and construction are known as non-banking, non-financial companies. This is another category, non-banking, non-financial companies. Any company engaged in the business of lease finance, hire purchase finance, investment in securities, grants of loans in any manner, including bill discounting, chit fund, insurance, stock broking, merchant banking, housing finance, or that of accepting deposit is identified as non-banking financial companies. And that the activities of the non-banking financial companies are given, or the major business done by the non-banking financial companies are given here. That is the lease finance, hire purchase finance, investment in securities, grants of loans in any manner, including bill discounting, chit fund, insurance, stock broking, merchant banking, etc. A brief history of non-banking financial companies are given in this section. It started in India in 1960s as an alternative to savers and investors whose financial needs were not sufficiently met by the existing banking system. And in the initial stage, they operated at a limited scale without making much impact on the financial industries. And in the initial stage, they were regulated by the Companies Act. However, the unique and complex nature of operation and with financial companies acting as financial intermediaries, there was a call for separate regulatory mechanism. And after that, Chapter 3B was included in the Reserve Bank of India Act 1934, which assigned the bank with limited authorities to regulate deposit-taking companies. And since then, RBI has initiated measures to regulate the non-banking financial companies. That is, in the earlier stage, the number was very small, and they were doing the financial helps to the in a very limited area. But after the expansion, separate and in the early stages, Companies Act was the regulating mechanism. When as the number of non-bank financial companies started increasing, separate regulatory authority under the Reserve Bank of India was introduced. The RBI accepted and implemented that the hire purchase and leasing companies could accept deposit to the extent of their net owned fund, as per the recommendation of the James S. Raj Study Group formed in 1975. And the companies were also required to maintain liquid asset in the form of unencumbered approved government securities. And according to the RBI regulation, the hire purchase and leasing companies could accept deposit to the extent of their net owned fund, and they are required to maintain liquid asset in the form of unencumbered approved government securities. Between 1980s and 1990s, non-banking financial companies with their customer-friendly reputation began to attract a huge number of investors, and the number of non-banking financial companies increased from 7,000 to around 30,000 in 1992. In 1992, RBI formed a committee headed by the former chairman of Bank of Baroda, Mr. A.C. Shah, to suggest measures for the effective regulation of the industry. And they provided a recommendation to the RBI, including the compulsory registration to prudential norm. The RBI formed a committee headed by the former chairman of Bank of Baroda, Mr. A.C. Shah, to suggest measures for the effective regulation of the industry, and the committee recommended the compulsory registration, prudential norms, etc. for the non-banking financial companies. In January 1997, there was huge change in the RBI Act 1934, especially in Chapter 3B, Chapter 3C, and 5 of the Act, seeking to put in place a complete regulatory and supervisory structure which would protect the interest and also ensure smooth functioning of non-banking financial companies. After the amendment of the Act in 1997, the NBFCs have grown significantly in terms of its operation. In 2016, the Union Cabinet gave the go-ahead for foreign direct investment under automatic route in the regulated non-banking financial companies. That is, in 2016, the Union Cabinet gave the permission for the foreign direct investment under the automatic. The types of non-banking financial companies are given in this section. The Reserve Bank of India has decided to merge three categories non-banking financial companies into a single category to provide greater operational flexibility to non-banking holders. Non-banking financial companies categorized as asset finance companies, loan finance companies, investment companies will be merged into a new category called non-banking financial company, investment and credit company, that is NBFC ICC. The three types of non-banking financial companies that were functioning include asset finance company. An asset finance company is a company which is a financial institution focusing on the financing of physical assets supporting productive or economic activities such as automobile, tractor, generator set, etc. These asset finance companies mainly provide financial assistance for the productive activities such as automobile, tractors, generator set, etc. Investment company provides financial institutions on the acquisition of securities. And third category is the loan company, which is a financial institution carrying on as its principal business the providing of finance, whether by making loans or advances or otherwise for any activity other than its own but not included in the asset finance company. That is, here financial activity or the financial helps will be provided in the forms of the loans and advances, but the loans will be other than those provided by the asset finance company. These are the three types of the asset finance companies that existed earlier, and these three companies were merged together, and now it is termed as NBFC, Investment and Credit Company, that is NBFC ICC. There are some regulations or the acceptance of deposit by the non-banking financial companies. That regulations are given here. Non-banking financial companies are allowed to accept or renew public debt. The non-banking financial companies are allowed to accept or renew public deposit for a minimum period of 12 months and a maximum period of 60 months. They cannot accept deposit repayable on demand. They cannot offer interest rate higher than the ceiling rate prescribed by the RBI. And next one is they cannot offer gift or incentive or any other additional benefits to the depositors. They should have the minimum investment grade credit rating. And the next feature is that their deposits are not insured. The RBI doesn't guarantee the repayment of deposits by the non-banking financial companies. These are some of the regulations regarding the acceptance of the deposits by the non-banking financial companies. That is, they are allowed to accept or renew public deposit for a minimum period of 12 or a maximum period of 60. They cannot accept deposit which is repayable on demand. Interest rate should not be higher than the ceiling rate. No type of gift or incentive should be accepted or given. They should have minimum investment grade credit rating. The deposits are not insured and therefore the RBI doesn't guarantee the repayment of deposits by the non-banking financial companies. The differences between banks and non-banking financial companies are given here. Non-banking financial companies is a company registered under the Companies Act 1956, and they are engaged in the business of loans and advances, acquisition of shares, stocks, bonds, debentures, securities issued by the government or local authority or other marketable securities of like nature. And the second one is the non-banking financial company does not include any institution whose principal business is that of agriculture activity, industrial activity, purchase or sale of any other goods, or providing any services and sale, purchase or construction of immovable property. These types of non-banking financial companies are known as, these types of banks are known as non-banking, non-financial companies. And another category is a non-banking financial institution, which is a company and has a principal business of receiving deposit under any scheme or engagement under any scheme or arrangement in one lump sum or in installment by way of contribution or in any other manner is also a non-banking financial companies, and they are known as residuary non-banking companies, RNBCs. This is the third category of non-banking financial companies. That is, in this case, it is a non-banking financial institution which has the principal business of receiving deposit under any scheme or arrangement in one lump sum or in installment by way of contributions or in any other manner is known as residuary non-banking financial companies. These are the three types of non-banking financial companies. That is, first one is non-banking financial companies, second one is non-banking non-financial companies, and third one is residuary non-banking companies. The non-banking financial companies can lend and make investment, and hence their activities are like to the banks, but there exists some difference between these banks and non-banking financial companies. The first one is non-banking financial companies cannot accept demand deposit. We have already seen that they can accept deposit for a minimum period of 12 or a maximum period of 60. They cannot accept demand deposit. Second one, they do not form part of the payment and settlement system and cannot issue check drawn on itself. The second important difference is that they are not part of payment and settlement system, and therefore these types of banking institutions cannot issue check. Third one is deposit insurance facility of Deposit Insurance and Credit Guarantee Corporation is not available to the depositors of non-banking financial companies. That is, the deposits with the banks are insured by the Deposit Insurance and Credit Guarantee Corporation, whereas the non-banking financial companies doesn't comes under this category, and therefore the deposit kept with them are not insured, and therefore the RBI is not responsible to provide the deposit, or they are not liable to pay back the deposits of the non-banking financial companies. The policy measures for non-banking financial sector in the last 2 years are given in this section. The Finance Bill 2019 through amendment in the RBI Act 1934 conferred powers on the Reserve Bank to strengthen the governance of Nbfc so as to protect the depositors or creditors' interest and secure financial stability. The first one is that the Finance Bill 2019 provides the Reserve Bank of India to strengthen the governance over the non-banking financial companies. And the second important changes that was introduced was the amendments empowered the Reserve Bank of India to remove the directors of the non-banking financial companies. That is, now the Reserve Bank can remove the directors of non-banking financial companies. They can supersede their board and appoint administrators in order to improve the governance and protect the interest of the depositors and creditors. That is, the RBI got more powers over the direction or over the board of directors of the non-banking financial companies. The RBI could impose penalties in case of non-compliances with various requirements. Another one is the government amended the company's share capital and debenture rule by removing the debenture redemption reserve requirement for the non-banking financial companies and housing financial companies. The Reserve Bank has revised the guidelines to raise the standard of asset liability management, that is ALM framework of non-banking financial companies, including core investment companies. That is, they have revised the guidelines to raise the standard of asset liability management framework. And as per the revised guidelines, more granular maturity buckets and tolerance limits along with adoption of liquidity risk monitoring tools were introduced. And as per this, non-banking financial companies were required to the maintenance of buffers in terms of liquidity coverage ratio, starting from 50% to percent for all deposit-taking non-banking financial companies and all non-deposit taking financial companies with an asset size of 10,000 crores and above, at 30% for all non-banking financial companies non-deposit taking with asset of 5,000 crores and above but less than 10,000 crores from December 1st, 2020 to reach 100% on December 1st, 2024. That is, here the non-banking financial companies has to maintain the liquidity buffer in terms of the liquidity coverage ratio starting from 50%. That is for the deposit taking non-banking financial companies and all non-deposit taking non-banking financial companies with an asset size of 10,000 crores and above. And the second category is 30% for all non-banking financial companies non-deposit taking with an asset size of 5,000 crores and above but less than 10,000 crores from December 1st, 2020 and to reach 100% by 2024. This is the liquidity coverage ratio requirements for the non-banking financial companies. All systemically important non-deposit taking non-banking financial companies, which is known as Nbfc and DSI, were advised to take appropriate actions as envisaged under the interest subvention scheme for micro, small and medium enterprises announced by the Government of India on November 2nd, 2015. Accordingly, 2% of interest subvention for all GST registered MSME on fresh or incremental loan will be given. In January 2019, a one-time restructuring of existing loans to MSME that were in default but standard as on January 1st, 2019 was permitted without an asset classification downgrade. This facility was also given to that type of institution. And the systemically important non-deposit taking non-banking financial banks in the category of ICC would be eligible to apply for a grant of authorized dealer category to license. This is another important change that has introduced in recently. And some of the important policy measures introduced are here with respect to the finance bill and the more regulatory powers on the non-banking financial companies, and here about the liquidity adjustment mechanism and the ratios to be maintained by the non-banking financial companies, and here about the interest rate mechanism or the interest rate to be followed by the systemically important non-deposit taking non-banking financial companies are given. Another important change introduced was this systemically important non-deposit taking non-banking financial companies would be eligible to apply for grant of authorized dealer category 2 license. And almost all non-banking financial companies were brought under the Reserve Bank's on-site inspection framework and its off-site surveillance commencing from inspection cycle 2018-19. The Ombudsman scheme for non-banking financial companies deposit taking was extended to eligible non-banking financial companies non-deposit with an asset share of 100 crores or above with customer interface. This is about the banking ombudsman scheme was also extended to the non-banking financial companies, and to the inspection. Almost all non-banking financial companies are under the inspection of framework of the RBI. The major differences between the banks and non-banking financial companies are summed up here. First one, non-banking financial companies provides banking services to the people without holding a bank license. Second difference is that bank is a government authorized financial intermediary that aims at providing banking securities to the general public. Second difference is that non-banking financial companies are registered under or incorporate under Companies Act 1956, where banks are under the Banking Regulation Act 1949. Demand deposit cannot be accepted by non-banking financial companies, whereas banks can accept demand deposit. For investment, allowed up to 100%, allowed up to 74% for the private sector bank. And the payment and settlement system is not applicable to the non-banking financial companies, whereas it is the integral part of the system. Maintenance of the reserve ratio is not required in the case of non-banking financial companies, whereas it is compulsory for the banking system. Deposit insurance facilities are now available, and it is available with the banking. Deposit insurance facilities are available in both cases. Then credit creation. In the case of non-banking financial companies, do not create credit, but this is the basis of the banks create credit. Transaction services are not provided by the non-banking financial companies, whereas it is provided by the banks. These are some of the important differences between the banks and the non-banking financial companies. The non-banking financial companies provide banking services without holding a bank license. Second one, it is incorporated under the Companies Act. Third one, they cannot accept demand deposit. Fourth one, they are allowed to take investment up to 100%. They are not part of the payment and settlement system. Maintenance of reserve ratio is not required for the non-bank finance companies. Deposit insurance facilities are available. Non-bank finance companies do not create credit, but transaction services are not provided by the non-banking financial companies. Now, the functions of non-banking financial companies are given here. Some of the important functions of non-banking financial companies are they provide assistance to the weaker sections of the society. Second one, non-banking financial company supports in the development of infrastructure and transport. Third one, they helps in economic development. Fourth one, they helps in the wealth creation. In addition to that, there is economic development, wealth creation, infrastructure development, and the helping of weaker sections of the society are the functions of non-banking financial companies. In addition to this, they perform certain important functions also. They include first one, the hire purchase services. This hire purchase service is a way through which sellers delivers the goods to the buyer without transferring the ownership of the goods. The payment of the goods is made in installment. Once the payment in installments are completed, the ownership of the goods is automatically transferred to the buyer. This is the hire purchase scheme. It's simply the installment payment system. Second one is retail financing. These non-bank financial companies provide short-term fund for loans against shares, gold, property, primarily for the consumption purposes. That is, they provide loans for the retail financing. Also, that is the short-term funding against shares, gold, property, especially for the consumption purposes. Third one is they provide trade finance. Trade finance in the sense that companies dealing in dealer or distributor finance, so that they can opt for working capital requirements, or they can approach the non-banking financial companies for getting working capital requirement, vendor finance, and other business loans. Next important function is the infrastructural funding. That is, this is the largest section where major non-banking financial companies deals in. A lot of portion of these segments alone make up a major portion of the fund lent. This mainly includes real estate, railways or metros, flyovers, ports, airports, etc. They mainly provides infrastructure funding to these types of, that is, they provide retail financing, trade financing, infrastructural funding. Another important function is provision of asset management funds. These asset management funds are provided by the asset management companies, which consist of fund managers who invest in equity shares to gain handsome gains, who invest the funds pooled by the small investors and actively manages it. Then another one is leasing services. That is, they provide leasing services to the needy people. It is similar to the way that we rent property or flat for living. Similarly, these companies provide property to small business or sometimes even large one who cannot afford it for whatever reason. The only difference between the renting and leasing is that in leasing, contracts are made for fixed period of time. Another service is venture capital services. That is, companies that invest in small business which are at their initial stage, but their success rate is high and are promising enough of sufficient return in the coming time. That is, this venture capital service is for the promising who are in the initial stages of their business. The next one is micro, small, medium enterprise financing. The MSME is one of the roots of our economy and millions depends on this, and accordingly these non-banking financial companies are also provides, or they are also liable to provide the funds to the MSME sector. These are some of the important Functions of non-banking financial companies that they helps in economic development, wealth creation, development of infrastructure, weaker section, hire purchase facilities financing, then retail financing, trade financing, infrastructural financing, asset management company. There is these asset management companies are the fund managers, who fund managers in the sense that they pool the savings and then invest it for the developmental activities. Then there is a leasing services, it is like renting, but the leasing means it is for a fixed period. Venture capital services are provided for the business people who are in the initial stages of their development. In addition to that, MSME loans are also provided by the non-banking financial companies. In addition to that, they also undertake so many other activities like underwriting, stockbroking, merchant banking, portfolio management service, foreign exchange related business, giving credit rating to other companies, etc. These are the major functions of non-banking financial companies. That in addition, the non-banking financial companies are financial companies. They do a lot of financial activities. The major difference between these non-banking financial companies and banks are that they cannot accept the demand deposit, or they are not required to keep the reserve ratios, and they are not part of the payment and settlement system. But all other activities, or the non-banking financial companies provides all other financial activities to the needy sections of the economy. We have seen the non-banking financial companies are divided into three categories: non-banking financial companies, non-banking non-financial companies, and the residuary non-banking finance companies. Here the what is a short description of residuary non-banking financial companies, that RNBCs are given. It is a class of non-banking financial companies which is a company has its principal business of receiving deposit under any scheme or arrangement or in any other manner, and not being investment, asset financing, and loan financing. That is, they can receive deposits under any schemes or arrangements. And the RNBC is a subcategory of non-banking financial company. RNBC is a non-banking financial company which receives deposit and is not one of the defined category of non-banking finance companies. That is, the defined category are leasing company, car purchase finance company, and loan asset finance company, and the loan company. RNBCs are classified as a separate category as their business, which has evolved over the years, doesn't conform to any of other defined non-banking financial companies. RBI supervises the companies through the mechanism of on-site and off-site auditing. This is the brief description of RNBCs. That is, RNBCs are sub-part of non-banking financial companies, but they are different from the different categories of non-banking financial companies. They can receive deposits under any scheme. This about the non-banking financial companies. We have seen there are different types of non-banking financial companies, then various functions of non-banking financial companies, a regulatory mechanism for the non-banking financial companies, and major differences between the banking and non-banking financial